Well, good morning. Thank y'all. Yeah, so I'm an economist, but I'm also a nice guy, I promise. Um, so the work I'm going to show this morning is stuff I've been working on for a couple of years now, and it wouldn't have been possible without the good folks at LSU and Louisiana Sea Grant. Um, they made the work possible, allowed me to do it, and allowed me to be here today to talk about it. And also, I've got some support from USDA's Ag Marketing Service. Um, so what I'm going to talk about, and, let's see, what I'm going to talk about is, so what we did is try to estimate farm costs, returns, profits, so on, under a variety of scenarios. Um, and to just get an idea of what average costs are and what possible outcomes might be. And so I'm going to start talking about farm size. And so we looked at anywhere from a half acre farm to up to a 4 acre farm. Later work, we look at some bigger sizes, but looking at investment costs and annual costs and so on. And the things that we're looking at, different factors include things like year types, stocking rates, seed costs, labor needs, labor costs, um, mortality, environmental conditions, and then of course prices received. So the first picture here, so along the bottom, I've got 6 different farm sizes, and they're being measured in terms of the number of oysters planted, and then also the approximate farm size in terms of acreage. And so there's, you see 2 different colored bars. So the blue bars are showing what we're estimating as the average capital investment at that farm size. And then the red bar showing the annual costs. So no surprises here. As the farm gets bigger, you'd expect costs to get higher. And so they're ranging anywhere from about $50,000, both in terms of investment costs and annual costs, um, to pushing to $200,000 and $250,000 at the larger farm size. So no surprises here. Farm size gets bigger, costs get higher. Um, but when we start to see uh, maybe less obvious relationships. And so with this showing, we're still measuring the different farm sizes on the bottom. But what I'm showing here, the different bars, it's the break-even price. So in other words, what is the average price you should receive to be able to cover your costs? And so what we're seeing is as farm size gets bigger, that break-even price is dropping, right? And at the smallest farm level, it's an extremely high break-even price. We're estimating somewhere above $2.50 an oyster. Um, but as they get larger, as we start to get to that 4 acre farm size, we start to approach that 50-cent price, which the work I've been doing, that 50 cents an oyster seems to be a recurring theme on price. So this picture, I don't know if in the back you can see it, but see it as well as the folks in the front. But what I'm showing here is we're just kind of digging into the weeds a little bit more. So we're looking at average profit, so revenue minus costs. and there's a bunch of dots here. You don't need to worry about what every dot means. But what we do need to know is each dot represents a particular scenario. In other words, a particular combination of farm size, stocking rate, market size stocking rate, that is, mortality rate, and the price. And our goal, so we're measuring profit along the bottom. And so our goal, where we want to be, is we want to have as many dots as we can on the good side of zero, on the good side of that red line. And so this particular picture is for those 2 smallest farm sizes that we looked at. And the key takeaway from this picture is that we've got a single dot on the good side. And so this is not to say that you can't make it as a small farm, but what our work is showing is that you need a lot of things to go right when you're that small. You need just about everything to go right. We've got 1 dot out of a bunch of dots getting on to the good side of zero. So if we move up to those medium sized farms, so the medium to between 240 to almost 500,000 oysters a year, the picture starts to get a little bit better. So it starts seeing more dots on the good side, right? On the good side is zero. But we're still seeing a lot of dots on the bad side. So what is it saying? As farm size gets bigger, you've got a little more tolerance for bad scenarios, but it's still a mixed bag. So you still need multiple things to go right when you're at those intermediate farm sizes. And then again, so the last one is those two larger farm sizes, the 3 and 4 acre farms. Things start to look better. We start to see more dots on the good side. And so what this is saying is that, larger farms, you need at least a couple of things to go right every year to be profitable. And so, the takeaway, I guess, from these few pictures is, although there's more risk, more investment, obviously, at play as you get bigger, you're able to tolerate more bad scenarios. Why is that? Because you're spreading those investment costs, you're spreading your labor costs, you're getting some efficiencies as you get a little bit bigger, and you're able to tolerate more problems. So the next set of results I want to talk about is it's a slightly different study I did, and it's focused on market size. It's actually focused on a combination of farm size and market size. But the story here is motivated by the idea that, does it make more sense to try to sell my oysters, directly into a local market, like Wood was talking about, the growers in Grand Isle, and their primary market is going to be New Orleans. Does it make more sense to move those oysters yourself, bringing them directly to the restaurants, and what you're expecting to get a higher price, right? And you should, because you're cutting out the middleman. Or does it make more sense to try to sell those oysters through a distributor? The idea there is you're not going to get the same high price, but you're probably going to have access to more markets, more distant markets. And so that trade-off between, um, where should I sell them? And so before I get into the results, I just want to kind of walk really quick through sort of all the factors that are at play. So on the supply side, what's determining how many oysters are going to be coming into that local market? Well, it's a function of how many local farms like you and everybody else. How many oysters are coming from each farm? What share of those local farms are selling into that local market versus selling them to a distributor or maybe selling them to a different market further down the road? Um, that's affected by the degree of access to a distributor. And then, of course, you've got oysters coming from other folks elsewhere, right? Oysters coming in from other states. Since 2020, we're seeing a surge of live oysters from Canada and Mexico. So is that a factor? And then, of course, external environmental factors that are going to affect production and supply. So you got a lot of things that play on the supply side. On the demand side, right? How many buyers, how many oyster bars are interested in local oysters? How many oysters are they buying? So how much does each restaurant need? And then of those, which share of their total demand are local oysters, right? You look at a menu for a restaurant selling off-bottom oysters, they usually have a variety, right? The whole idea is to offer the customer variety. So they're not buying all of your oysters. They're buying oysters from all over the place. And of course, external factors are going to deal with people's taste and preferences, income, and so on. So those two sides are both going to play a role determining what the local branded half shell price is or the off-bottom price. It's going to they're going to play a role in determining the distributor, the wholesale price of those oysters. And then, of course, there's the residual market, right? We're probably, most of the folks here are probably not planning to sell their oysters to a shucking house, but there's always that residual market that's there. Okay, so this first picture, checking my time, this first picture is looking at a simple question of how many oysters are produced locally and how many can be absorbed by the local market. And so along the bottom, we're measuring different market sizes. So from smallest market size, farm size, to the largest. So in other words, the average market size in that local market, average farm size in that local market, I'm sorry. And so what we're measuring, the height is the number of oysters that exceed how many oysters the local market can absorb. And so what we see is that, sure, when all the farms are small, in a small market, there's not a lot of excess, right? In other words, the amount of oyster supply matches how many are being demanded. But as the farms grow, as the average farms get bigger, you get more excess oysters. In other words, what does that mean? It means you're going to have to find an alternative outlet to that local market to sell your oysters. And a small market, just to give you an idea, I'm assuming a market that's got about 10 restaurants. And I kind of had New Orleans in mind when I did this. All right, slightly different picture. So what am I showing you here? So we're looking at a scenario of a small local market, about 10 restaurants, 10 oyster bars, and the average farm size locally are small farms. So what are these bars? These different colored bars are different strategies, like I mentioned earlier, to sell your oysters. From one extreme, the purple bar being your plan is to sell all of your oysters yourself directly into that local market. To the other extreme, the blue bar where it says 0%, that's where you're just going to push all your oysters into a distributor, and then a few in between. And so what we're looking for is we're looking for the tallest bar. What we're measuring here is the average price received per oyster. And so what we're seeing is that even when the market, when the farms are small, in a small local market, it still does not give you the biggest returns to sell them all direct. You still should have a backup plan to sell at least a portion of your oysters through a distributor. And that's because of that earlier graph I showed that the local market gets saturated and you got to go somewhere else with it. As the farms get bigger, what we start to see is the optimal strategy. In other words, the biggest bar, it's starting to shift away from direct marketing. So as all the farms are getting bigger, everybody's contributing to a lot of oysters going into that fixed market size. And you got to have an alternative. You got to have an alternative outlet, right? And as the farms get even bigger, we see the same thing. It just does not make sense from an economic perspective to try to market all of your oysters locally directly. It makes sense to hook up with a distributor, try to move some of those oysters. You're getting a smaller price per unit, right, for the ones you're selling wholesale, but you're finding a market. You're not having to send as many oysters ended up on a residual market. Now, if the market is bigger, obviously there's more room for more oysters, right? So this is, I'm assuming 30 restaurants. So there's 30 buyers in that local market. So you got more room, obviously, but even in that bigger market, excess supply still does occur. So even as those farms start to grow, you're still going to have an alternative. And so what this is that same story I just told you for the smaller market. What do we see when all the farms are small? Yeah, it makes sense. You can sell them all directly and get that higher price. But as the farm sizes get bigger, the strategy shifts towards trying to have a more balanced approach, selling some directly, but having a relationship with the distributor to sell some as well. So I'm going to stop there for questions. But the big takeaways. If you're a small farm, less than 4 acres, you need a lot of things to go right to make it happen. You got a lot more room for error as the farm size gets bigger. On the marketing side, you need to make sense to have a backup plan. Don't necessarily plan to sell all your oysters yourself directly. Make a relationship with the distributor and have that backup plan to sell them. Thanks.
So we can take a couple questions. So questions for Dan? Back there, Chris.
Pyramid.
Great.
Right.
All right, we'll take one more question before we move on to Rutgers. Jim?
I was surprised to see that your initial investment cost was actually a little bit less than the annual cost. Was that the annual cost for 1 year, or was that for the whole period of the assessment?
So I was showing, so that's the annual cost of the first year. Excuse me, the investment cost is for the first year, the gear and capital and everything. And then the annual cost is the average over a 5-year period. But you're saying one was a little lower than the
I
other.
just, had always sort of mentally
So
thought that
labor,
the initial
that's
investment
probably-
cost was your, the biggest, all the gear, all the rope, all the permitting. And so
Yeah.
it was interesting to see that you were also sort of seeing annual operating costs basically match that, as you go into the
Yeah,
industry.
and it's labor. Labor seed is not in the investment. Well, some of the seed is in the investment cost, but it's primarily labor. But then you're also starting to pay interest and you're paying the loans on the investment.
All right, we gotta move on, but Dan is around, right?
Yeah.
So, okay, all right,
Thank
again,
y'all.
thank you, Dan, appreciate it.